is with me, so straight away to him. Samiran Chakraborty, good morning and thank you very much for joining us here. You kick off the CNBC TV18 Investor Conference interactions. First up, your thoughts on the GDP. Is this a bigger slowdown than you discounted?
Well, we all knew that this quarter is going to be distorted by the WPI increase or the GDP deflator increase. We were baking in that in our forecast. But what was a bit of a surprise is the lack of revision in the earlier data because of the IIP and WPI. So we're thinking that the whole series will be kind of parallelly shifted upwards, which did not happen. And that's why there was a bit of a gap between our expectation and where the number came.
Fair enough.
But the second point is actually more important, that what should we look at, the real GVA or the nominal GVA? And it seems that people change their minds depending upon which quarter what suits them. So if you look at nominal GVA is actually the best that we have seen in almost 2-3 years. And that kind of correlates well with the fact that we saw a bit of a corporate earnings growth revisions also in this year. And in fact, in our indices of rural demand, urban demand, investment, everything was showing some amount of pickup in the fourth quarter compared to the third quarter, which seems to be completely belied by the real number because of the messing up with the deflator. But I think the third point is also very important, which is the divergence that we are seeing between consumption growth and investment growth.
Yes.
I think that's becoming quite a bit of a worry for me. We cannot keep on having a 10% consumption growth and a -2% investment growth. And last but not the least is this private sector. Is that weaker than what the GDP data suggests? Because if you take out the farmers and if you take out the government, then what is left is growing at a meager 3.4%. That's not a number which I would be very comfortable with, even adjusting for deflator, etc. Okay. So this is what my broad take will be. It's a soft number for sure, but it's probably not as soft as the optics would suggest.
Okay. Well, Anuj, Sonia, I mean, that point that Samiran is making is very important. Farm sector gave 4.9% for the last, for the full year and about 5.2% for the last quarter. As well, government contribution, public administration, maybe 7th Pay Commission, maybe other investments as well, was as high as 17% growth in the fourth quarter itself, and even for the full year it's about 20%. So if you minus that, then it looks like the GDP and the GVA are softer numbers. But Samiran, yesterday I spoke to a bunch of economists. They have not revised their number. SBI has not, and other brokerages have not revised their FY18 number. What about you?
No, not really. We are still looking for about a 7.5% increase in FY18. The broad hypothesis that we are working with is that the FY18 growth will be marginally higher than FY17 because of a plethora of reasons, from lower interest rates, from NPA resolution helping the investment cycle, state pay commissions impacting consumption, global growth situation looking much better than FY17. So we still believe that those broad macro trends that we were looking at, they will play out over FY18, and keeping the faith on a marginal increase in growth rate. And also the fact that we don't know how much these numbers are going to get revised. You might have noticed that we had 3 quarters of investment contraction. All 3 quarters have been revised up to almost about a 5% growth now, which is very much in line with what we were thinking at that point of time. We could not believe that investment was contracting over that period. So to what extent this GDP data will get revised also is a big question.
No, but the more important question was what I was raising and what the bond markets will raise. Will this color Reserve Bank's or the MPC's stance? It's already moved into neutral stance. My sense is that, moving away from that stance is going to be difficult, but do you think it will be nuanced? Will or should the market pencil in a rate cut at all in the next 2-3 policies?
So 2-3 things here. So one is that if you look at even the neutral stance, how the RBI or the MPC explained it, it clearly said the neutral stance gives us flexibility to move both ways.
Yes.
So it's not that you cannot cut even when you are on neutral.
Yes.
The second is that if you look at the data prints between April and June, inflation has surprised on the downside, growth has surprised on the downside. Exchange rate has appreciated, global commodity prices have remained more or less where it is. Monsoon forecasts have been upgraded, so to say. So if you put all this together, there's enough and more reason to sound somewhat more comfortable on the inflation front than what they were in April. Now the question is that, do you cut in June or you wait for another 2 months where there are a variety of one-off events that are going to hit you? So you have...
Are you actually expecting there could be a cut? How much of a percentage?
We are looking at about a 40% probability of a rate cut in June.
Okay.
We would have gone all the way only if these event risks were not there. So you have monsoon, you have MSP increase, you have GST implementation, you have the mean reversion of vegetable prices still to play out, you have the HRA increase. There's so many such one-off factors between June and August. So the MPC might just wait to see how these things play out before taking a final call on this.
Okay. Then give me an idea of how bond yields may move. What is your expectation if there is a cut? I know it's extremely hypothetical because we have the monetary policy in just a week. But nevertheless, bond yields reacting to this number could move south, you think, in the run-up to the June 7th event? And generally over the quarter, what is the...
I think what has changed clearly is that the part of the bond market which was fearing that there could be a hike down the road, that has definitely come down, that expectation. Yes. And on that basis, the markets have rallied about 10-15 basis points. Now, the next question would be that, is there a rate cut? I think this data will prod some people to think that there might be a rate cut. But the bigger question really is that if and when that rate cut comes, would the market overshoot and start factoring in more than one rate cut?
Oh.
And that's where the real kind of rally can start. Otherwise, it will be a very short, shallow rally. It will not be really something which we will remember for a long time.
Okay. Well, Samiran, we'll leave it at that. Thank you very much for joining us. I'm sure you're going to get a barrage of questions.